Hey everyone, this is Rob Keents at goldsilverpros.com, and this is Sunday, March 7th, 2021. And as promised, this past week, I'm going to do a video on Jeffrey Christian's interview with Kitco. And this is in response to much viewer interest that I've gotten, people emailing me constantly throughout the week. Had I seen this interview between Kitco and Jeffrey Christian? Yes, I had seen it. And I wanted to break down a response for you and deliver this in detail to some of the claims and arguments that Mr. Christian made in that interview with Kitco. And I'm going to start doing that tonight, although I got about 12 minutes through the video, and I think I'm going to have to do this in two parts. There's a lot that I'm going to talk about here, and we're going to go step by step through the entire thing. So we will do it. We're going to do it in two parts. I'll probably do one part this week and one part next week. And then we'll kind of go from there. But there's a lot, I think, of information in this that is, for Mr. Christian's part, is not very well explained, not made clear, use of terms that could potentially mislead if you didn't understand how the market worked and could read between the lines of what he was saying. I'm not going to say that he did this on purpose, although some of his numbers are just flat out wrong. I'm going to prove it with the data. And some of his assertions need further look for people to understand how the market really works and whether or not to believe his interpretation of what he'd been saying. So without further ado, let's go ahead and jump right into it. And I'm going to go very slow because I've got a bunch of tabs open on my browser. So this is going to be quite a bit of work here to get through this. So bear with me as we get through it. I want to make sure and address each of the points in detail. So we're gonna, okay, hide meaning control. So this was originally on March 2nd, 2021, about a week ago. It's called Silver Squeezers Will Just Lose Money. Jeff Christian debunks price suppression theories. This is Kitco News. I'm looking at the YouTube video version of this. I want to go ahead and play the beginning of the video. I'm going to stop the video at points throughout, and we're going to talk about the interview and just different aspects of that interview. Let's go ahead and get started.
Well, it looks like the silver squeeze is still happening, and I'll explain why. Jeff Christian, managing partner of the CPM Group, is here to discuss silver and what happened last month and how the markets are still reacting to what happened last month. Jeff, it's a very interesting discussion we'll have today. I'm looking forward to it. The CPM Group is launching a report this Thursday talking about the silver squeeze and some of the things they got wrong. You were telling me offline. Why don't you start by introducing us the synopsis of this report?
Okay. Well, yeah, the silver report that we're releasing on Thursday isn't actually about the silver squeeze. It's about the silver.
Okay.
CPM Group for the last 16 years has had a silver reception on opening night at the PDAC. PDAC is virtual this year. So rather than do that, we will have a webinar at 11 o'clock Eastern time on March 4th. It's open to the public, and I think Kitco is one of the distributors and media partners in that project. But it's going to be a global webinar covering silver. And simultaneous to that webinar, we'll produce a report, a small report, as we have for the last 16 years with the silver reception at the PDAC. Now, obviously, one of the topics that we'll cover is the short squeeze and what they got it wrong. We'll show some data about what happened with the SLV in the first week of February.
Yes.
And we'll show some data about the enormous amounts, record amounts of silver that's held in bullion form, good delivery bullion form in London, New York, Zurich, China, and why it is that there's no real shortage of silver.
Okay, I'm going to go ahead and stop it here. He said a couple of things here, and I wanted to clarify for a lot of people who don't follow the silver market, who may be watching this for the first time. Of course, a lot of my followers do here at goldsilverpros.com, but for the benefit of some viewers that either don't understand the gold and silver market and understand what we're talking about, the short squeeze and where that came from, that movement came from, or people that understand the gold and silver market but hadn't followed it. Let's define some parties and groups here better than what Mr. Christian has done to lead off this video. So Wall Street Bets was a group here on Reddit, you're seeing it here on Reddit, that had advocated some certain positions in GameStop in AMC theater stocks, because these were stocks that were essentially penny stocks at the time. Investment in those to make money. Those are, of course, highly speculative positions. Wall Street Bets here was not, I don't believe, responsible for the silver squeeze movement. And in fact, I had a lot of people come on my channel after we all started talking about this at the beginning of February, about who is responsible for this. And a lot of the people that were involved with Wall Street Bets or have been following Wall Street Bets came on my channel and said, don't attribute anything silver squeeze to us. So it's not the people that were involved in GameStop and AMC that were advocating the silver squeeze, or at least not officially on this channel, or not as a movement on this channel. There is a separate movement now on Reddit called Wall Street Silver. This group and the people involved in this are more involved in the silver squeeze movement and advocating silver. These are not the GameStop and AMC people or people advocating taking positions there. They're also not the people that advocated taking positions in thinly traded penny stocks and going along those to bid up the price, which is also something that was advocated on Wall Street Bets. Further, the people involved with Wall Street Silver aren't all millennials, although I have given credit because a lot of my viewers are younger for getting involved in the silver squeeze movement. But my understanding from people who have posted here on Wall Street Silver and who have messaged me that they're following this are from many different generations. They're from millennial generation, my generation, which is Generation X, even the baby boomer generation. And so it's the movement involves a wide swath of the population across many different age groups and income levels, and really has nothing to do with Wall Street Bets. So I just wanted to make that clarification. Also, Mr. Christian interview so far has said that there is plenty of silver available. He's going to make that assertion again later on in the interview. I'm going to provide more clarity on that because the numbers he uses aren't correct, but I'll wait until he gets to those numbers to do that, which you will hear in a moment. Let's continue the interview.
There's a shortage of like coins and small bars, but there's no shortage of silver.
Okay. A friend of mine actually texted me last night. He said, check out this GoFundMe. And what they're doing is they're raising money to short silver again. So they've raised about $77,000 so far. I think their goal is $100,000. And I'm not entirely sure what they're going to do with this money and how they're going to utilize it to short silver. But anyway, I think it's there's still interest from at least the millennial crowd to continue the short squeeze trade. What do you?
Again, the host here is incorrect. It's not just from the millennial crowd. I know for a fact it's across multiple generations. This is lazy journalism on the part of the Kitco host.
Make of this.
The problem with these guys is they don't know what they're doing. They don't understand commodities markets. They have been playing with freely margined equity trades on the equity market, where you actually have investors who will borrow shares of a stock of a company and then sell those shares in the expectation that they can buy them back if the price falls more cheaply to pay back their loan. So you do have naked shorts in the silver market as shorts. In the commodities market, you have some investors who do that, but the vast majority of the positions that you see as short positions on the commodities exchange across commodities actually are hedges of physical positions by commercial trade entities.
Okay, a couple of things here. I'm going to stop it right here. First of all, Mr. Christian falls all over himself when trying to compare the shorting in the commodities markets, including silver, and the stock markets. They're different entities. The stock markets, when you go naked short, you're shorting without being able to borrow shares from your broker. It is not a naked short if your broker allows you to have those shares. So not all shorts in the stock market are naked shorts. When you're in the futures market, in the commodities, specifically in the precious metals as well, if you're shorting, but you do not have the metal to back that short, meaning you haven't gotten a warrant or gotten access to metal to back that short position, that is a naked short. So the vast majority of shorts on those commodities exchanges are naked. They're not backed by the actual physical metal. In contrast to the stock market, in which a lot of the shorts are backed by shares. Of course, those shares are borrowed from other account holders, but the brokers are allowing you to borrow them, have temporary access to them to back it up. So there's a difference in the shorting in the stock market as well as shorting in the COMEX markets. We're going to listen a little bit more.
Now, one of the mistakes that people who don't understand commodities markets make is they think that when it says commercial short position, they think that those are producers and refiners and fabricators.
Well, as a matter of fact, part of the commercial position is producers and merchants. And I'm going to show you that with information directly from the CFTC COT report, but I'll let him talk himself into whole a bit more before I do that.
Commercial, industrial companies. But in reality, most industrial companies do not trade directly on the futures market.
This is wrong, and I'm going to show you that in a moment. This is blatant misinformation from Mr. Christian.
They trade with banks or dealers because it's more convenient for them, they think. And then those banks and dealers will hedge their physical or OTC transactions with futures and options. So the commercials that get reported through the commitment of traders are actually primarily financial intermediaries, banks and dealing companies.
Okay, this is incorrect. So let's get to the CFTC report and I will show you guys how this is wrong information. The easiest way to do this is to look at bar chart. I'm going to show you the actual CFTC report that comes, I'm sorry, the COT report, Commitment of Traders report that comes from the CFTC. But I want to show you this visual version first because it's easier for most people to understand. My understanding is bar chart gets their information from this very same place in the CFTC. So let's look at it. Here is the silver COT report on bar chart. Has the silver price here, and then below it, it has the different categories of longs and shorts. You can see who's long because they're above the zero line. You can see who's short because they're below. And if you tap on one of these lines, it'll actually show you the report. So I'm looking at this yellow box here, SIH 18 in the upper left hand. It will tell you the COT long and short positions, also tell you who's doing it. So COT LCL is going to be the large spec, which is the blue here. And there's going to be 7 of these. There's going to be 3 here at the top. This is the aggregated report, and this is disaggregated where they break it out into more individual positions. And that's important because this is where we're going to prove Mr. Christian wrong. So again, going back to this yellow chart, we have the large spec, which is COTLC parentheses L. We have the small spec, which is COTLC parentheses S. And we have the commercials, which is COTLC parentheses C. Okay. Now broken down into the 2 better categories, I think, are the 4 bottom categories because they tell you more about who is going to be doing what based upon how you think their position would be in the market. I'll explain that here in a moment. The producers is COTDLC parentheses P on this yellow box. The swap dealers here at the bottom is COTDLC parentheses S. Of course, managed monies is parentheses M, and other reportable is parentheses O. Now to define who these are, the producers, which are part of the commercials here, part of the commercials are the producers, are the people that are actually producing the metal. So the producers of the silver, the miners. And that also includes the merchants. So producers and merchants both go in there. Producers generally go short the commodity price, if you think about it, because they want insurance in case the price falls. So if the price of silver at one point was $27.50 and they expect that it could go down to $26.50, they want to hedge that potential loss by the time they get the silver out of the ground and bring it to market. So they take a short position in the futures, meaning if the price does fall, they can take that short position, cash it in, make a little bit of money off of it, and offset the fall in price against their actual physical sale later on when they've produced their doré bar or their silver bar and they sell it to the market. The merchants, which is not shown here, producer merchant in the same category down here, the merchants are the ones that actually use the physical commodity. So they're worried about the price rising because if, say, silver goes from $26.50 to $27.50 an ounce, that's $1 more an ounce they have to pay for the silver they're using in, say, their Apple iPhone or their Tesla car or in their piece of dental equipment or medical equipment or wherever silver is being used there. So they'll go long. So the producer merchants here will be a combination of longs and shorts. The swap dealers are the bullion banks. By definition, if you go to CME Group website, the swap dealers are the bullion banks. They're the big banks that Mr. Christian has said he thinks trade is trading for the producer merchants, but we can see here producers already broken out into its own category. Then you have the managed money, which are typically the hedge funds and the other financial interests. They typically don't take delivery. They're usually playing for price speculation or financial speculation. Then you have the other reportables, which are made up of wealthy individuals, family offices, small to medium-sized businesses. They fit on that category. So Mr. Christian said just a moment ago the producers typically don't trade on their own. They trade with the swap dealers. That's not correct. They have their own category, and yes, they do. Okay, now we're going to go to the CFTC Commitment of Traders report. This is a disaggregated report. So what we're going to see on the report are these 4 reporting categories down here, not the aggregated ones, but these 4. So we're going to go down to silver. This data is as of March 2nd, 2021. It's the latest one available right off the CFTC's website. You can see here by the URL here in the address bar. We're going to scroll down and we're going to look at silver, and you can see that we've got producer merchant. Okay, so Mr. Christian, if what he said was true, this entire column of producer merchant wouldn't even exist. But it exists not only in silver, it exists here in palladium, it exists here in platinum, it exists here in silver, it exists here in gold, it exists here in copper, it exists here in aluminum, it exists here in US Midwest domestic hot roll steel, busheling ferrous, lumber. Okay, so it exists in all of these categories. So he's wrong. He's flat out wrong. This is the easiest thing to debunk in the whole video, but I'm going to spend a lot of time on it because it's key to understanding his arguments. Now, I wanted to take a moment and do a little bit of math. So I'm going to have to stop sharing and reshare screen so I can get my calculator up because I didn't share the calculator. So hold on just a moment. Let me reshare screen again. And we're going to make sure we share the entire screen. Okay, we're sharing the screen, and then I'm going to bring up the calculator. Hopefully this comes up for you guys, calculator. So here's calculator. So we're going to calculate the amount of short positions that the producer merchants have right here in the silver market. So 59,553 as per the last report. Now, it's interesting to note that while this will change between last week and this week when Mr. Christian made his assertion, it doesn't change significantly enough to change the argument. These numbers will go up and down, but these positions stay relatively the same, at least week over week. So we're going to use 59,553, and we're going to multiply by 5,000 ounces of silver. Right now, the producer merchants are shorting almost 300 million ounces of silver. Now, according to the Silver Institute, less than 1 billion ounces were produced last year. So this would be about 30, it's a little over 30% of the silver produced in 2020. And about 30% of what's expected to be produced this year, which according to the Silver Institute, I think is 1.025 billion ounces they're projecting out. About 30% of that is being shorted right now. So the producer merchants are shorting a third of their entire expected use of silver for 2021. Now, that's a pretty sizable position. Why would they need to do 6 months or the whole year? They wouldn't. This is about 4 months of production. Why would they need to do more than that? They probably wouldn't, because think about it. If you're using a futures contract that expires in a few months, because there's about 5 to 6 really big delivery months in a year in either gold or silver. 5 big ones, maybe a 6th one if you count that. And you can take delivery any month you want, but we're talking about the ones that have big open interest. So think about it. You have 5 chances out of 12 to take a futures position. And if you look at the CME Group data for silver, see if I can get over there, you can see the open interest. Let's go to the volume chart. This is silver, of course, right off the CME Group website. You can go and look at the open interest. The vast majority of open interest right now is for the May contract. There's a little bit left in April. There's some building for July, but most people will trade a single contract and then a little bit on a couple of other contracts. You see here about 25,000 contracts here, but about 125 here. So the vast majority in 1 month. So if you're only going to trade a couple of 3 months ahead of time in a silver market, why would you need more than a couple of 3 months? Why would you hedge more than a couple of 3 months of production? If you can continue to roll those contracts and change your position on the COMEX, you don't need basically to cover your whole year's production. So this 297, almost 300 million ounces, or in other words, almost 60,000 contracts of 5,000 ounce silver is enough to cover their position on the contract, on the May contract. They don't need to take a heavier position than that. Therefore, when we see the swap dealers right here coming out with 42,298 additional short contracts, the producer merchants don't need that to cover their position. They've already got what they need until the May month. This is more than enough to cover up until the May month. Okay, go back. Where is the volume? Right now it's on the May month, the vast majority of it. Okay, a little bit July, September, December, but not much. Most of it in this month. So what they have here is 59,553 contracts. We go to the calculator, is more than enough. You're looking at 30% of the entire year's production. So when the swap dealers are adding 42,000 contracts, let's see what that is. 42,298. Let's just say 42,300 times 5,000 ounce silver. The swap dealers are adding an additional 211 million ounces. That's about a fifth or 20% of the world production for the entire year. That would bring the total between the two columns to be over half, well over half of the silver mined every year. But why would you have that if the forward contract that everybody has open interest in, that they're hedging their positions with, is in May, which is just a couple of months away. And you have these other trading months. You have 3 more big trading months in silver: July, September, and December. See, that doesn't logically make any sense, which is why his assertion doesn't make any sense. There is enough coverage on the producer merchant category, both short and long, for the producers and merchants, that they don't need the swap dealers. So I'm contending that what Mr. Christian said is wrong. And I think it's extremely clear in the numbers. And I'm spending a lot of time on this particular point because I want you to understand what was said was an outright falsification. Now, I'm not saying he had the intent to falsify, but if you listen to that video segment, he fell all over himself trying to explain how the shorts work. And then he said the producer merchants don't, use the COMEX, they go to the swap dealers, but according to the CFTC, they have their own category. How could you not, and they have enough to cover, 30% of the annual production of all silver. If you really followed, if you're the CPM group, you're the managing partners, Mr. Christian is, and you really followed silver that long, and for 16 years, you're going to PDAC and having the silver open session, how could you not understand that this category existed? How could you not understand that they're shorting 30% of world production, which would be for legitimate hedge reasons? How would you not understand that? How could you possibly, being in Mr. Christian's position, make that mistake? I don't know. So I can't contribute intent to him because I'm not him, but I can severely question whether or not he really understands this market. Let's go back to the video. Oh, wait, let me redo the share again, make sure I have sound. Sorry, I just want to make absolutely sure that we're getting sound on this. Okay, I am sharing sound, so we'll go back to the video and we'll play it.
And that's one of many mistakes that these guys don't understand. In addition to that,
no, it's a mistake you don't understand, which I just proved conclusively. Thank you.
You had some problems because they were trying to squeeze the SLV ETF on the first week of February, and they didn't understand that the problems that arose, they misdiagnosed them, and
I'll disagree with him here. I don't think people misdiagnose the problem, but I'll agree with Mr. Christian here in a moment when he says SLV is not the way you short squeeze. I've said that myself in videos, so let's continue to listen.
I can explain that if you really care, what actually was happening there with the SLV. Yeah. But it wasn't that the metal didn't exist in London the way they thought. It was really much of a more mechanical issue with just clearing the volume of trades that they had.
Yeah, for sure. We really.
Okay, now I don't necessarily disagree there would be an issue with the mechanical volume of clearing trades because there was a lot of metal traded, and I'll wait till he gets to the numbers to debunk his data. But I do disagree that there's a lot of silver available in London, and I'm going to prove that with some numbers, 2 different sources here in just a moment.
Okay, we're really interested to know why the short squeeze didn't push up silver above $30 an ounce. People were expecting it to happen, but it kind of just fizzled out. We didn't see the same effect as GME, AMC, all these other stocks. What happened there? I mean, there's a lot of theories as to why it didn't work out. Some people speculated that it actually did work because what we saw was a run of the mill on the physical front. The bars and coins, the dealers were out of inventory, so the premiums on the physical side, so the paper market didn't move up, but the physical side moved up. You saw premiums rise, right? So how do you digest this?
When you say the physical market, you're talking about small products.
Yes, Jeffrey, that is part of the physical market. Thank you. According to the Silver Institute, the investment demand for silver is quite a big market. It's something like 30% of the silver market every year. And I can link the Silver Institute report if you want. It's about 30%. It's about something like 270, 280 million ounces. So that market he's just talking about, the small product market, is a very substantive amount of the overall silver demand. Thank you.
Coins, medallions, and small bars. And those premiums skyrocketed because small investors who didn't know what was going on in the futures market and with SLV got all excited that the price of silver was going to rise, and they bid those things up. There's also shortages of those small products because of the way mints and refineries have managed their production facilities to avoid the pandemic spreading across their people.
Now I'm going to debunk this real quick. I'm going to have to sort through my things to find it. The amount of U.S. mint sales of Silver Eagles between 2021 and 2020, the first 3 months of, are pretty close together. So what he's saying is the mints had to be careful because of the pandemic and exposing their people, so they had to slow down production. I think that was true at a certain period of time. If you looked April through, say, August timeframe, yes, there was a slowdown. And at that same time, and I've showed this before in a previous video, I'm not going to show that report now, but there was an uptick in the EFP, exchange for physical mechanism, at that same time that we were having physical supply shortages due to mint closures and mine closures last year due to the pandemic. So in other words, people were taking their silver demand from the US over to London through that EFP exchange mechanism on the futures market on COMEX at about the same time. So he's partially correct, although that has seemed to recover, because if we look at the data, we can see that the overall mint production of US Silver Eagles for the first 3 months of 2020 and 2021 is not that far off. So let me really quickly go up here and find, we're going to screen share again, and I'm going to find what page that is on. Sorry, I hit the wrong button. Let me hide the controls so I can find where the mint sales are. Sorry, guys, it's going to take me just a minute. Like I said, I've got so many tabs open. It's going to take me a while to get to some of this. There's so much misinformation in this video that I wanted to get to all of it. Here's bullion sales. Okay, sorry, it took me a while to get to. So this is 2020 American Eagle sales. This is usmint.gov. You can see here in the address bar. So 2021, there were, and let's bring up the calculator. I'm going to calculate, this may be a calculator off screen, but I'm going to add the numbers. 4,775,000 plus, and I'm adding this column here, ounces sold. We're going to add 3,191,500 plus 761,000. So far in 2021, actually, you can only add the first 2 months because essentially we haven't got all the way through March. So let me do that. 4,775,000 plus 3,191,500 equals almost 8 million by the numbers. Now let's go to 2021. So we're going to go here, American Eagle. We're going to go to sales by month, and we're going to go back to 2020 and submit, and we get new numbers, and we're going to look at those numbers. So let's add. So January, February of 2020, I think the numbers are quite a bit smaller. 3,846,000 plus, and this is 650, just 650,000. So for the first 2 months of 2020, we had 4.5 million. And for the first 2 months of 2021, we had almost 8 million. So let's divide the number 4.5 million divided into 8 million. 56%. So in 2020, in the first 2 months, we had 56% of the American Eagle sales that we've had so far in 2021. So question is, if we had more sales and one of the most popular, I'm nitpicking a little bit here because I'm only looking at American Eagles. I'm not looking at all silver coin sales or all sales, but American Eagle is a good representation of US demand for silver bullion products because it's by far the most popular silver bullion product. There was an additional 44% of American Eagle sold in 2021 versus 2020. So again, here, 3.8 plus 650 is about 4.5. We go to this year and it's about 8. So it's 44% stronger than American Eagle silver sales in the first 2 months. So that means that they're able to basically run enough production at the mint to get 44% more American Silver Eagles out from the mint than they were last year. So how much is the pandemic actually affecting the US mint silver sales right now? Obviously not at all. And I believe most of the silver miners have since reopened. There are probably still some closures, but the majority of them have reopened. So the silver supply coming out right now is enough so that all the other mints could probably print as much as they wanted as well, where they're doing, individual mint coins and stuff like that. But just picking American Silver Eagle data, we can show that there isn't a slowdown in overall production. So that's not a valid point. Let's continue.
And we can talk more about that. So that's one of the things. The other,
yeah, let's talk more about that, Jeffrey, because you made a contention there, which basically is disproved, at least when looking at the U.S. mint numbers of silver. So what you just said about mints having to close their doors of the pandemic and not produce as much is wrong, at least in terms of that specific market. One of the strongest silver markets in the U.S., or strongest silver coin issuances in the U.S., if you will.
thing is, I would argue that, and in fact, in our report, we'll have a chart that shows you, and we'll show it on the webinar. The price of silver rose in late January into early February because of the role of futures out of the February contract, or out of the March contract into the May contract. And that was one of the factors that was supporting the price at that time. Whether or not the SLV squeeze attempt.
Okay, I'm going to stop him right there. He's basically saying they're rolling contracts from one to another, and that led to a price spike. So the thing about the CME Group is they don't let you go back to previous months unless you pay them a lot of money for their data. But this is a normal practice. Most of the contracts, and getting to a point about how many naked shorts there are in the COMEX. If you look in May, for example, at the open interest, you got 124,000 open contracts trading on the May contract. And that affects the current price. So to understand how the futures market affects the price, you take the nearest biggest month in a commodity, especially gold and silver, and that's what controls the price. Because why? Because that's where most of the settlements are going to be. The settlements determine the futures market's price. So where are most settlements occurring? It's occurring in May. Okay, we had, as of Friday, March 5th alone, almost 80,000 settlements. You only saw about 5,000 or 6,000 in the other months. Let's go back to Thursday. You had 96,000 settlements for the May contract. You only had, like another 6,000 in other months. Okay, go back to Wednesday when the actual settlements are 83,000 on the May contract. They're only about 4 to 5 here on the other near-term months. So it's this May contract which determines price. So dependent upon what settles every day is the price that you're going to get. That's why I've on my videos probably 40 times since July of last year, I believe, when I started talking about silver on these videos, I've tracked where this settlement price almost is identical to the current trading price. In fact, let's look at Friday's data. It settled on about 25,287. The current price is 25.550. Okay, and it's traded. It's increased a little bit because you can see here about 1% because the market is opened. We're after the Sunday market open. But if you look at the settlements, this price right here that you get on a given day's data is almost going to match what the current silver price is. And this is trading on the May contract because this is the majority of the trades. So what you have is the majority of trades are paper. They're not physical settlement. Let's go to the actual metal settlement numbers. This is the month-to-date delivery notices. I'm going to make this a little bit bigger, folks, so we can actually see the numbers. But this is straight from the CME Group. And this is the March 2021 as of 3/5/2021 data. Okay, so you know I'm using current data. Here's the COMEX 5,000 silver futures. We've had a total for the month on 7 business trading days of 9,344 delivered, actual physical delivered contracts of 5,000 ounce silver, 9,344. Let's look at the volume for a single day, 80,000. Okay, another day, 95,000. Another day, 83,000. Another day, 82,000. Another day, 70,000. So let's say an average of 75,000. I'm going to run my calculator on this. Say an average, we'll be conservative, if 75,000 contracts traded a day for 5 days. Yeah, for the 5 days of data that we have. Okay, that's 375,000 contracts. Okay, divided by, now I'm only doing 5 days, not 7. So I'm cutting off 2 days because we don't have 2 days worth of data, but available on CME Group because they only do a rolling 5 days. So I'm actually being generous and counting less futures contract closures, paper contract closures than physical. Let's divide that by the 9,344 deliveries. divided by 9,344 deliveries gives us 40 times. There have been 40 times the amount of paper traded on this market than there has been physical. That's called naked shorting. There's 40 times more as naked shorts on this market that were not backed by physical silver, at least physical silver trading, okay, than there were the paper contracts. Let's go back to what he's talking about.
Actually had a lot to do with the price strength at that time is questionable. And it's questionable for a variety of reasons. One about, if you look at other markets, there were other commodities, including gold and platinum and palladium, that were rising at the same time. So you don't know why they would be rising if people are focusing on squeezing the silver market.
Okay, this is easy because first of all the markets trade based on the futures. If you look, all of the futures markets trade the same. They settle with this tremendous volume that is so much more than the actual deliveries. Look at March 5th data. This is March 5th data. You had 85,000 contracts trade, but you only had 431 deliveries. 85,000 divided by 431. What is that, 160? 160 times the amount of paper trades as compared to the physical trade. And that's true of all the markets. So it doesn't matter if there's a silver squeeze movement. That's completely has nothing to do with what happens in gold or happens in sugar or oil or any other commodities futures market. What's the point? I understand, because people were focusing on the silver futures market, that all of a sudden the gold, everybody stopped trading all the other futures market. No, there's more participants than just trade silver. So this is a complete straw man argument that he's using here, and it's a silly argument.
So it looked like it was a broader set of factors that were pushing silver prices up at that time, as opposed to the squeeze.
So if a bunch of investors or a large community of investors buy the SLV ETF, does that have any effect at all on the underlying price of the commodity itself, silver?
It can have an effect on a short-term basis. You know, the reality is, as I said, I mean, you have record amounts of silver in London and New York inventories. The SLV, it's very funny because some of these guys were talking about COMEX silver and not having enough silver in New York to meet the SLV demand, which is not true. You had enough. But it's doubly not true because the SLV actually takes metal in London, not in New York. If you look at the London inventories, you're at record levels. You've got about 1.1 billion ounces of silver in London inventories. About 450 million ounces of that is unallocated. So ostensibly it's more readily saleable. Although to tell you the truth, a big part of the allocated metal can also be sold too, because it's not that difficult. If you own allocated metal, it's not that difficult for you to say, gee, the price is 20%, 30% higher than when I bought it. I think I'll take my profits.
Okay, now here's where his numbers are completely off. He gets off in his numbers with SLV as well. But here's where his numbers off in terms of the London market and what's available. I'm going to close some of these tabs so I can better get to some of this information. We've already looked at cotton and all that stuff. Let's look at the actual numbers on the LBMA. He said 1.1 billion ounces. He's correct. Here's straight off the LBMA website, London Vault Holdings data. Here's silver. He has this number correct, 1.1 billion ounces. So that's correct. But his other numbers are incorrect. I'm going to show you two sources. So he does mention that SLV has about 600 million ounces. And now, to be fair, this data is a couple of days newer than when he did his video last week, but it's still about 600 million. So give or take a few million in redemptions to the SLV, he's correct. He's right on that number, about 600 million ounces. And this is information off of Nick Laird's site, Gold Charts R Us. I'm going to show you some other information here from a moment from Ronan Manley. But there are all these other ETFs, a lot of which hold their ounces in the London market. You have a lot, and I'll show you exactly which ones here in a moment. So in other words, you can't just take, this is stupid math, or it's uninformed math on Mr. Christian's part. You can't just take the 1.1 billion ounces and subtract out the SLV ounces of 600 million and get about 450 to 500 million free ounces, because other ETFs hold their metal there. Another point I want to make is he talked about London market being unallocated. That's true, and it's OTC, which means they're private trades. So nobody really knows, sans the iShare ETF holdings and the other ETF holdings, how much is really available. What unallocated actually means is that you can't back each derivative position or each claim to the silver with an actual ounce. If you could, it'd be allocated. Now, in addition, out of that 1.1 billion ounces minus the 600 million SLV ounces minus all these other ounces owned by these other ETFs, you could also have an allocated position in which it is held by someone. And yes, you could get that metal away from them if you pay them a high enough price, but maybe they're holding it in the London vaults because they want safe storage and they don't want to give it up. So this is something that's true on both the COMEX vaults and the London vaults. And I'll get into this a little bit more here in a moment, but essentially any allocated, or on the COMEX is really termed eligible inventories, are not being traded. They're privately held, and to get them, you have to pay the price that the owner wants. So just because they're there doesn't mean they're immediately saleable. That's up to the individual owners. It's not up to the exchanges. That's a point that I want to make really clear. Okay, now fast forward to a Ronan Manley article. If you haven't read Ronan Manley, I love his research. He covers the London market better than anybody I've found, and he has an article here dating back to February 7th, 2021, called Houston, We Have a Problem, 85% of silver in London already held by ETFs. So now we go back to the chart here, 87%. So if you subtract 1.1 billion ounces minus the 600 million held by SLV, that's a lot more available than the 15% that Ronan Manley's saying. So what he does is he looks at all the ETFs and ETCs storing silver in the London vaults. He gets the iShares about, at the time he did this article, it was 654. At the time that Mr. Christian was in the interview, it was about 600. Okay, but if you add up all these other ETFs, they're at about 922. So if we subtract out a little bit over time and just say 900 million ounces of the amount that the LBMA claims to have, the 1.1 billion, that only leaves 200 million ounces, not the 450. Why? Because all these other ETFs, a lot of them store it in London. And these are the ones, the Wisdom Tree, the Invesco, ETF Securities, Australia, the Aberdeen Standard, the iShares SSLN, X-Trackers, Bullion Vault, and Gold Money. Bullion Vault and Gold Money are basically private services who aren't ETFs, but they have private held storage from their members. Bullion Vault has 15 million ounces, Gold Money has 6 million ounces. So that adds up to 900 million. So if you subtract 200 million out of 1.1 billion, you get less than 20% available. Certainly less than the 450 million available that Mr. Christian says is available. Another thing that I wanted to talk about, it's going to take me a moment to find. Okay, now here's an admission. When we're talking about the COMEX, Mr. Christian is right in that the silver would more than likely first come from the London market because that's where the ETFs stored their silver. But I just showed you where they didn't have all the silver Mr. Christian said they did. They may only have 200 million ounces, and the SLV, the inflows to the SLV, his numbers were incorrect. These 3 days, and I don't know why the green's not showing up here, but there were 3 days of increase at the beginning, end of January, beginning of February. Let's go back just a little bit. Here it is, right here. End of January, beginning of February, the 3 days where there were 110 million ounces. It wasn't 95 million ounces that Mr. Christian's going to say in the video. It's 110. Now, a lot of that has since been redeemed. Most of it has been redeemed back out. But there are 110 million moving into SLV in those 3 days. At the time, there was not that available. There's only 200 million, the 1.1 billion minus the 922. So you, unless all of that was immediately liquid, and again, it's unallocated market, you don't know if all of it's liquid. But if somehow the market could have, in those 3 days, cleared out that much metal, okay, you would have had the silver. But more than likely they couldn't, so you would have had to come over to the COMEX. So let's look at the admission by the COMEX that their data may not be, all their held gold and silver may not be all available. So here is on the CME Group's website. This is on April 9th, 2020, a memo that was sent out talking about CFTC regulation regarding spot month position limits. Buried in here is something that has nothing to do with position limit. It has to do with inventory. So we're going to skip past the position limit discussion. And we're going to go to the second page where they're talking about how COMEX estimates the amount of freely available metals. It says here, the exchange determined at this time the basis estimates of deliverable supply of gold. And this applies to silver too, because the system is the same for silver and gold. So just substitute the word silver for gold here and you get the exact same effect. The basis estimates of deliverable supply of gold on eligible and registered stock stored at exchange approved depositories. Silver has the same, eligible and registered, so same principle applies. The exchange recognizes that gold is used as an investment vehicle, and as such, some gold stock may be held as a long-term investment. Going on, while surveys conducted indicated no clear consensus as to how much gold is dedicated to long-term investments, the exchange, in an effort to represent a conservative deliverable supply, that may be readily available for delivery made a determination at this time to discount from its estimate of deliverable supply 50% of reported eligible gold at this time. In other words, when you look at the eligible categories of gold, they're saying 50% may not be deliverable. And that same thing applies to silver, because when you look at the category of eligible, it's privately held. It's like the privately held allocated gold on the London market. They're basically analogous, okay? If it's privately held, you can't guarantee it's going to come back to the exchange. It's up to the private holder to say they want to at a given price at a given time. It's a private decision. The exchanges cannot guarantee that those eligible inventories on COMEX for gold or silver are available. Now, further bombshell in this report, and I've covered this on my channel before, we're going to cover it again. The exchange may, at a later date, determine not to discount such stock or to recognize a discount level that is more or less than 50% of reported eligible gold when calculating deliverable supply estimates. In other words, they don't know that that 50% number is even a good number. Could it be 70%, 80%, 30%? They're admitting they don't know, and they can change it later. Blah, blah, blah. And then they go into a table which basically discusses the whole thing. So they're basically saying, we don't know how much gold and silver could be available. Now I'm going to stop sharing on this screen. I'm going to go to the actual inventory, current inventory report for silver. So this is from CME Group. This is from March 5th, 2021, the latest data available, because the CME Group only allows one data of this inventory sheet at a time. As soon as the new day is available, this sheet disappears and you can't get it unless you save it on your computer. Let's go to silver. This is for silver troy ounces, and they have 128 million as of this time. And if you look about a month ago, I think it was about 137 million. Now, I did show this about a month ago, this report a month ago, so you can go back and look at videos. It's about 137 million. Okay, keep that number in mind, 137 million. This memo I just showed you from the CME Group will tell you that they don't know how much of this eligible category here, this 261 million ounces of silver, is available. They don't know. They said it could be 50%. It could be more or less. We don't know why it's privately held. That's what eligible means. Eligible cannot be put onto a futures contract unless the private holder takes that eligible and says, we want to put it on the futures contract. Analogous to that in the London market, if you have allocated silver, okay, that's part of that overall 1.1 billion ounces, and you want to sell it, you can in the OTC market, but you have to make it available. You have to go to people and say, yes, I want to make that available. It's privately held. So the allocated position on London and the eligible category in COMEX is basically, for all intents and purposes, analogous. It's not immediately available. And I'm going to go back and show you from the website where the COMEX admits this, the exchange determined that it could be 50% or more or less than 50%. It's this paragraph right here. So they're basically showing that, well, we don't know how much of this in this memo on April 9, 2020, off of their website. You can see the URL here. They don't know how much is available because it's in private hands. So if you go back to the numbers, backtrack a minute and go back to the numbers, 1.1 billion minus all this held in the SLV and these other ETFs equals, we thought at the time, beginning of February, about 200 million free, not the 450 that Mr. Christian says. Assuming this is an unallocated market, so you don't know how much is then allocated and held privately versus how much is available, and you don't know how many paper claims are sitting on top of, you know, the ETF minus allocated available unallocated gold. That is some amount less than 200 million. Maybe it's 100 million, maybe 125, maybe 60. We don't know, and neither does Mr. Christian. That would not have satisfied the demand going into SLV over 3 days, which was 110 million. So some of that would have had to come from COMEX, and the COMEX didn't have basically it had enough, but you had to ship it all over in 3 days, which according to COMEX takes at least 3 days to exchange it on the COMEX. And we're not talking about shipping it over to London. And they only had at the time about 137. Now this number's gone down to 128 million, because you can see here, you've had some redemptions from registered into private stock. You can see on this report. So on this report, March 5th, 3 million ounces, but overall about 9 million in the last month has moved off of registered into eligible or off the exchange. So COMEX barely had enough by itself to handle that 110 million ounces that went into SLV supposedly. In London, it's debatable whether they even have 110 million ounces available, because remember, 1.1 billion ounces, according to London, is vaulted. 900 million ounces are ETF or ETC owned. You then have some allocated owned. So that's 200 million minus whatever is allocated owned. Now, there's private contracts that we don't know, but it probably was around, they probably may have had 110 million ounces that went into SLV those 3 days. Maybe, maybe not. We don't know for sure, and neither does Mr. Christian. Okay, so got through all of that. Let's go back to the video and we're going to listen to more of what Mr. Christian has to say.
So there's plenty of silver around. The issue that happened with the SLV is that if you look at
how does he know there's plenty of silver around? I just got through saying that we don't know how much silver is available in London, but it was most likely at or about the number that was demanded in only 3 days. So if you had another 3-day period like that in LCV again, you wouldn't have had the silver. But even then, we can't prove in London because of private contracts how much is actually available, how much is unallocated. We don't know how much is allocated versus unallocated. LMA does not report that. And in the COMEX market, it would have taken the vast majority of available registered silver on the exchange out of the 137 million ounces, and they would have had to fly it over. It would have taken more than 3 days. So whatever went into SLV those 3 days, as soon, the SLV says they actually got it in those 3 days. Didn't come out of London market by itself, and it couldn't have come from COMEX because it takes longer than that to physically deliver it. So availability is relative term, relatively speaking.
the SLV trading volumes, not the trading volumes, but rather the volumes of redemptions and additions to inventories on a daily basis, the average day trades somewhere between zero. There are a lot of days where there's no redemptions or additions to the SLV inventories, but typically it trades between 0 and maybe 1 or 2 million ounces of shares being added to or taken out, and it goes both ways.
That's exactly right. That's why 110 million ounces over 3 days could have bankrupted London and partially bankrupted the COMEX. The numbers I prove the point that the silver squeeze had an effect on the market, even though they're going through the SLV, which, by the way, the prospectus is littered. If you look at the prospectus starting on page 6, and I've showed this before on my website, and I'll link it down in the video. If you look at the SLV prospectus starting on page 6, they have all sorts of disclaimers that says they cannot guarantee that the silver will be of quality that an investor would expect, that they don't get to audit the sub-custodians, which hold most of the silver. It's not JP Morgan, the custodian, it's mostly sub-custodians. So it could be missing, not there, not real silver. It could be something other than silver. It says that in the prospectus. So there's no guarantee that what SLV has is actually silver. But even if they could get it, that 110 million ounces in 3 days was a vastly different trade than what had happened in the past. According to him, he says many days with 0, many days with 1 or 2 million. Those 3 days, end of January, beginning of February, saw 110 million. So obviously that did affect the market because SLV actually could get that silver. And according to logistical and the numbers and the logistics of getting the silver there, we don't think they could have. But even if they did, it would have drained most, if not all, the available silver in the London market and then come over to COMEX. That's a big deal.
When these guys tried to squeeze this thing, all of a sudden you shot up to like 95 million ounces.
It's 110 million ounces. His numbers are wrong.
Of new additions to the SLV. And then they realized that there was a mistake and they liquidated about half of that, about 45 or 50 million ounces.
No, it wasn't they realized there was a mistake. There's probably one of two things happening. It wasn't physically feasible to get 110 million ounces in 3 days. So probably some people sold, maybe some people sold to take profit, but it wasn't because all of a sudden people realized they'd made a mistake. No, because the silver price was shooting up at that period of time. And we showed in previous videos how it was the paper trading on the COMEX market that basically smashed it down. In fact, it was this 372,000 contracts, which is by far the highest BART on this chart at CME Group, 372,000 contracts. This is what slammed the silver price down. It wasn't the Wall Street silvers at 110 million ounces of demand at SLV. It was this massive paper shorting on February 1st that slammed the price down. And then another big massive short on February 2nd that slammed the price down and caused the price to fall. We documented that at the time. You can go back and look at my videos on those dates to see how the paper trade affected the silver price. It wasn't the SLV trade. And again, as I said many, many times, all you do is you track the nearest biggest month, and that sets the price of the commodity, both in gold and silver. And I prove this over and over and over again in videos. This is what sets the price in the American markets.
Over 2 days.
Yeah.
And you've got a system that clears on average a couple 100,000 ounces worth of silver SLV shares a day, sometimes 1 million or 2 million ounces worth of shares. All of a sudden that system is needing to clear 95 million ounces.
Exactly. So they couldn't do it. That's why SOV couldn't have got that 110 million in 3 days. And Jeffrey Christian's basically admitting that here. And it could be a combination of the fact that it wasn't available in London, or their mechanisms not set up to handle that kind of demand, which just goes to prove the point that the silver squeeze movement worked exactly as intended.
And it's just not there. So it wasn't that the metal wasn't there. It was that the capacity to clear 95 million ounces worth of SLV shares in a given day wasn't there.
How does he prove that when nobody knows the amount of available unallocated silver on the London market at which SLV stores its silver? He doesn't know. We don't know. We're guessing that there may be 200 million, but the max is 200 million. Could be much less than that when you account for allocated silver positions, which aren't reported publicly. So how does he have this information?
Can you tie all this back into a recent YouTube video that you've done entitled "Silver Futures Contract Default Not Likely"? And what do you mean by that?
Well, there are a lot of people, again, who consistently misunderstand, purposefully or by accident, how the market works. So you've had people.
I think we understand how the market works. I think we proved that either you don't know how the market works, or you're not providing correct information on how the market works. I can't attribute intent, but it's very clear that your understanding, Mr. Christian, is very clouded.
People since the mid-1980s say that, oh, there's not enough silver to meet all the demand, and you're going to see a default in the silver market. And you've had promoters, primarily people who sell precious metals products, touting to investors, oh, the silver market's going to explode because there's not enough silver to meet all this demand, and there's these massive naked shorts that don't actually exist.
Yes, they do. Go back to the data. It's irrefutable. Look at the volume numbers. Again, the only thing that can prevent a naked short is actually trading the physical metal. Just looking at one, I'm just going to pick one day, Friday, March 5th, latest day. You had open interest of 124,000 contracts, but only 431 deliveries. So you had 431 deliveries on Friday, March 5th. Let's look at the settlement data. How many of those settled in actual metal? 80,000 contracts traded with an open interest of over 124,000, but only 431 delivered. That's what you call naked shorting. That's the definition of naked shorting. And again, it's the nearest big month which determines the price, because it's a futures market, not a now market. So you take the futures open interest and settlements. Open interest is open interest either way. Settlement is what you actually settled a contract, 80,000 divided by the actual deliveries in the current month, 431. That is a naked short market. Because otherwise, what are these settlements for? They're paper settlements. These 80,000 settlements did not result in the delivery of 80,000 contracts of silver. And you have to have a short on every settlement. There's a short and a long. It's naked short by definition.
On the COMEX, and the silver market's going to explode. And, Kitco has interviewed me for 30 years about this. JP Morgan's going to go bust. Goldman Sachs going to go bust. Merrill Lynch before them. Drexel Burnham in the 1980s, had these massive naked shorts, which they didn't, but they're going to blow up in their face. And you'll see these guys come on Kitco. You guys like to promote them, and they'll say, oh, by October, the price of silver is going to be $100 because it's going to blow up. And it doesn't blow up, right? If you look at...
There's a reason, Mr. Christian, why it doesn't blow up. And I love how he takes shots at Kitco. He did this to Daniela in an interview last year, I believe it was April or March or April, where he basically accused Kitco of allowing conspiracy theorists onto the site, which is just not the professional way to handle things. But in any case, you notice how he talks back in the 80s about Drexel Burnham and all that stuff. Why doesn't he mention the back-to-back fines from Scotiabank and JP Morgan? The largest fines ever levied for manipulating the precious metals markets came from Scotiabank, 127 million, I believe it was. And then later, JP Morgan in September, Reuters had the story, 920 million for manipulating precious metals in the treasury market. And it says here, and in a subsequent press release, the JP Morgan traders admitted to manipulating silver, admitted to manipulating it. Not just that they paid the fine, but they admitted to manipulating it. JP Morgan Chase & Co. has agreed to pay more than $920 million and admitted to wrongdoing to settle federal U.S. market manipulation probes into its trading of metals, futures, and treasury securities, the U.S. authorities said on Tuesday. The landmark multi-agency settlement lifts a regulatory shadow that has hung over the bank for several years and marks a signature victory for the government's efforts to clamp down on illegal trading in the futures and precious metals market. Did Mr. Christian, was he not aware that this had come out last September 29th? If he's managing partner of CPM Group and he has the silver open at the PDAC every year for 16 years, did he not see this news? JP Morgan will pay $436.4 million in fines, $311.7 million in restitution, and more than $172 million in disgorgement, the Commodities Futures Trading Commission said on Tuesday, the biggest ever settlement imposed by the derivatives regulator. Between 2008 and 2016, JP Morgan engaged in a pattern of manipulating in the precious metals futures and U.S. Treasury market, the CFTC said. Traders would place orders on one side of the market, which they never intended to execute, to create a false impression of buy or sell interest that would raise or depress prices according to the settlement. The manipulative practice, which is designed to create the illusion of demand or lack thereof, is known as spoofing, or lack thereof, shorting to bring down the price, to create an illusion of lack of demand. Lack of demand, what happens? Lower price. Aha. Some of the trades were made on JP Morgan's own account, their house account, not for customers. While on occasion, traders manipulated the market to facilitate trades by hedge fund clients, the CFTC said. The bank failed to identify, investigate, and stop the behavior even after a new surveillance system flagged issues in 2014. So in other words, they knew it was happening and they did it anyway, and they admitted to it. Scotiabank got caught doing the same thing, and they're actually getting out of the gold futures market because of this fine. And this was announced maybe a month or two before the JP Morgan one. Back-to-back record fines. So why do you bring up Drexel Burnham in the 80s when we have data right here, Mr. Christian, in 2020, that they're admitting to spoofing and to manipulating the markets?
The ratio of, say, what they tend to do is they'll look at the ratio of open interest to metals.
No, what I do is I look at the settlements to metals. Yes, open interest tells you how many open contracts are, but the settlements will tell you how many futures positions are closing in which is involved a short that does not take delivery of metal. And I've showed this twice now during this video.
And they say, okay, there's big open interest, 700 million ounces or whatever, and there's only 400 million ounces now of silver registered or eligible in the New York market to meet that COMEX demand. So if everybody who has open interest.
Now, the registered may meet COMEX demand because that's what's put forth for delivery. The eligible is not put forth for delivery. The eligible, Mr. Christian, is privately owned. Okay, go back to the CME Group admission on this April 9th memo. And I'm going to read this again for Mr. Christian in case he failed to catch this one. The exchange determined at this time to base its estimate of deliverable supply of gold, and again applies to silver because the categories and the scheme is the same, on eligible and registered stock at exchange approved depositories. The exchange recognizes that gold is used as an investment vehicle, so is silver. Again, the Silver Institute estimates about 270 million ounces of the billion ounces produced this year, so about 27% will be investment demand. Is used as an investment vehicle, and as such, some stock may be held as a long-term investment, i.e. in private hands, not for trading on the exchange. While surveys conducted indicated no clear consensus, and what they had done, we find out further details in this, is they'd gone to the depository and said, how much of this eligible can you actually release to the futures market? There's no clear consensus. In other words, it's private hands, they don't know. The exchange, in an effort to represent a conservatable deliverable supply that may be readily available, meaning we don't know, made a determination at this time to discount from estimated deliverable supply 50% of his port of eligible gold. You could say the same thing for silver. Why? The categories are the same. The exchange may at a later date determine not to discount such stock or to change it to more or less than 50%. Okay, let's go back to silver. He just said 400 million ounces in silver. Is there 400 million ounces in the registered category? No, at the time he made that video, it was about 137 million. The rest of this, about 400 million ounces, 389 now, is ineligible. That's private storage, in which I just read to you the memo where the CME Group said, yeah, we don't know how much of this is actually available. It creates the impression of false liquidity in the system. It's all privately owned. There's no warrant on it to go to the futures market. You cannot steal it. If the exchange tried to take this category of silver or gold and put it into register without the consent of the owned, they would get sued and they would lose because it's privately owned. I don't know how many times I need to make that point. I've made it on my channel so many times. I've lost count, but I don't know why Jeffrey Christian, managing partner of CPM Group, is supposed to really understand these metals markets, doesn't make that distinction multiple times in his video.
Takes delivery, the market blows up and defaults. First off, it doesn't default. It just changes to a cap.
All right, so I'm going to go ahead and stop here because he's going to get into default and all that kind of stuff, which I'll get into, maybe get into in a subsequent video. But at this point, I think I've completely debunked the first 11 minutes and everything he said just about in the 11 minutes. The only thing I agreed with him on is that there were some redemptions in SLV. Other than that, I pretty much disagreed point for point with everything he said in the video and backed it up with data. So you can tell in the first 11 minutes, this does not seem to be a credible source. And this is a little concerning because, as he said, they're the silver open at the PDAC. The PDAC is the largest minerals investment conference in the world, Prospector Developer Association of Canada. The thousands of people go, thousands of investors go. I've been to it twice. It's a great conference to learn about, minerals, mineral mining, all the companies that support that, all the miners, a lot of data on how all of this works. And how could you be the open for 16 years and not understand the basics of how this market works? Where it's easily, some of his theories and his speculations, I'll call them because they're not facts, are easily debunked with public information. It took me about 45 minutes to put together before this video. I don't quite understand. I don't quite understand how he doesn't understand this, how CPM Group doesn't understand, but that's very concerning. And for him to go accuse Kitco, not once, but twice, once Daniel is interviewing him here, I believe, is it Daniel who's conducting the interview, and then before where he does the same thing to Daniela last, I think it was March or April, where he basically accuses Kitco of lying the conspiracy theorists on, when they actually back their points more with data and more with objective facts than he does, is really the pot calling the kettle black. So this is going to end this video for today, guys. This has gone very long. I want to spend a lot of time talking about the first 11 minutes of the video because there were so many misrepresentations, whether intended to or not. I cannot attribute intent to him, but it is concerning. There are so many misrepresentations, bad data points, either obfuscation or misguided definitions of terms, accusations against his host that I think were unfounded. This interview was a mess, and all it took was 11 minutes to basically show where I'm not sure that this should be a credible market analyst going forward. We may go back and look at the back end of that video as well in another week. I think the first 11 minutes I've done enough, but we'll see what happens. But thanks, guys, for joining this. Rob Kientz with goldsilverpros.com.